Welcome to Wealth Path. We're glad to be with you on this journey to grow wealth and achieve financial freedom together. Today, we're diving into a practical strategy for building long-term wealth, especially if you're just starting out in your 20s. If you're wondering how to turn a modest $100 per month into a solid financial foundation, this video is for you. We'll walk you through getting started with investing, understanding market cycles, and how building a long-term mindset can help you achieve your financial goals. Let's dive in. In our previous video, we discussed why it is important to fully capture the time value of money by starting investment early and shared practical ideas on how to save $100 per month in your 20s. In this video, we'll talk about where to invest that $100 you've saved. For beginners, a great approach is to start with low-cost, diversified investments like index funds or ETFs, which give you broad exposure to the market without needing to pick individual stocks. Index funds and ETFs, these two terms are often used interchangeably, but they're actually a bit different. An index fund is a type of mutual fund designed to mirror the performance of a specific market index, like the S&P 500. Because index funds are typically purchased directly from investment firms, like Vanguard or Fidelity, they're only priced once at the end of each trading day. ETFs, or exchange-traded funds, work similarly to index funds in that they also aim to track a specific index, like the S&P 500 or Nasdaq 100. However, there are some important differences. While index funds are typically bought directly from an investment firm, ETFs are traded on stock exchanges like individual stocks, which means you can buy and sell them throughout the trading day. This gives ETFs more flexibility in terms of when and how you can trade them. Now, let's look at a few popular index funds and ETFs, including some that track the Nasdaq, which is often a great option for young investors who want exposure to high-growth tech companies. So, what exactly is the Nasdaq? The Nasdaq is a stock exchange, but it's also the name of two major stock indexes. The Nasdaq Composite, which includes over 3,000 companies listed on the Nasdaq, and the Nasdaq 100, which focuses on the 100 largest non-financial companies, mainly tech firms. Popular index funds. Vanguard 500 Index Fund, VFIAX. Tracks the S&P 500, giving exposure to 500 large U.S. companies. Fidelity Zero Total Market Index Fund, FZROX. Tracks the entire U.S. stock market with zero expense ratio, making it an extremely low-cost option. Schwab S&P 500 Index Fund, SWPPX. Another S&P 500 index fund with low minimums and low fees. Popular ETFs. SPDR S&P 500 ETF, SPY. One of the first and most popular ETFs that tracks the S&P 500. Vanguard Total Stock Market ETF, VTI, provides exposure to the entire U.S. stock market. iShares MSCI Emerging Markets ETF, EEM, gives exposure to emerging markets, adding a layer of international diversification. Popular Nasdaq options. Invesco QQQ ETF, QQQ, tracks the Nasdaq 100, which includes the 100 largest non-financial companies on the Nasdaq, mostly in the tech sector. Fidelity Nasdaq Composite Index Fund, FNCMX, a mutual fund that tracks the entire Nasdaq composite, including more than 3,000 companies, not just the largest 100. First Trust Nasdaq 100 Technology Sector Index Fund, QTech, a focused ETF that provides exposure specifically to tech within the Nasdaq 100. The Nasdaq is often associated with technology and innovation, making it attractive to young investors looking to invest in high-growth companies. Investing in a Nasdaq-focused ETF, like QQQ, or a Nasdaq index fund, like FNCMX, gives you exposure to companies like Apple, Microsoft, and Amazon, which have driven a lot of market growth over the past decade. Investing in Nasdaq-focused funds can be particularly appealing for young investors for a few reasons. First, the Nasdaq includes many of the fastest-growing tech companies, which have been major drivers of stock market performance. You're investing in companies that drive global innovation and lead in fields like software, artificial intelligence, and green tech. However, the Nasdaq is heavily weighted in technology, so a downturn in tech can impact the index significantly, so Nasdaq can be more volatile than S&P 500. For young investors, who have a long time horizon, the Nasdaq can be a good option if they're comfortable with the added volatility and want exposure to high-growth companies. But remember, balancing it with broader market funds, like an S&P 500 or total market fund, can help spread out risk. Now, you are ready to invest your $100 per month. You'll need to open an investment account with a brokerage or investment firm. Here are some top choices for young investors, all of which offer easy-to-use platforms, low fees, and options for automatic investing with as little as $100 per month. Vanguard is known for its low-cost index funds and ETFs. It's great for long-term investors looking to invest in diversified, low-fee funds. Vanguard has no account minimums for its brokerage accounts, and their funds are specifically designed for passive, long-term growth. Fidelity offers a range of zero-fee index funds, like FZROX, which is a total market index fund with no expense ratio. They also have an easy-to-use app, and no minimums to open a standard brokerage account, making it a great option for young investors. Charles Schwab offers a variety of low-cost index funds and ETFs, such as SWPPX for the S&P 500. They have no account minimums, commission-free trading on U.S. stocks and ETFs, and a robust educational platform for investors who want to learn as they go. Robinhood is a popular option among young investors due to its user-friendly app and commission-free trading. For all of these brokerage accounts, you can set up recurring deposits, so your $100 investment can go to a mix of ETFs and stocks automatically, with no fees on most accounts. Many also allow you to invest in fractional shares, which means you can buy a portion of an expensive stock or ETF, making it even easier to get started with a modest budget. Now, let's move on to understanding market cycles. The stock market moves in cycles, with periods of growth, peaks, downturns, and recoveries, with phases of growth referred to as bull markets and decline as bear markets, and it's normal to see these ups and downs over time. These cycles are particularly relevant for tech-focused investments, like Nasdaq funds, which can see greater fluctuations. Understanding these cycles can help you stay calm during market downturns. For example, during tough times, many investors panic and sell their investments, fearing losses. But for long-term investors, downturns can actually be an opportunity to buy at lower prices and build wealth as the market recovers. Let's look at a few real-world examples to give you an idea of how these cycles work and how significant the swings can be. Let's start with one of the most famous bear markets in recent history, the 2008 financial crisis. This downturn began in late 2007 and continued through early 2009. Sparked by the collapse of the U.S. housing market and a crisis in financial institutions. During this period, the S&P 500 dropped by about 57% from its peak in October 2007 to its lowest point in March 2009. While this was a severe downturn, those who stayed invested in a diversified portfolio and continued to hold through the crisis saw their investments recover and grow in the following years. For example, by early 2013, the S&P 500 had returned to its pre-crisis levels, and those who held through the downturn eventually saw strong gains as the market continued to climb. Following the 2008 financial crisis, the U.S. experienced a prolonged bull market, one of the longest in history, which lasted nearly 11 years, from 2009 to early 2020. During this period, the S&P 500 rose by about 400%, offering incredible returns for investors who stayed the course. This cycle shows how markets tend to recover and grow over the long term, even after major downturns. More recently, we saw a quick but severe bear market at the onset of the COVID-19 pandemic in early 2020. As uncertainty hit global markets, the S&P 500 dropped by about 34% in just over a month, from February to March 2020. However, this was followed by an equally rapid recovery, with the S&P 500 not only rebounding to pre-pandemic levels by August 2020 but continuing to reach new highs. On-screen visual. More recently, we saw a quick but severe bear market at the onset of the COVID-19 pandemic in early 2020. As uncertainty hit global markets, the S&P 500 dropped by about 34% in just over a month, from February to March 2020. However, this was followed by an equally rapid recovery, with the S&P 500 not only rebounding to pre-pandemic levels by August 2020 but continuing to reach new highs. This example highlights that markets can react sharply to unexpected events, but they often recover just as quickly, especially in cases where economic stimulus or recovery plans are implemented. So what can you take away from these examples as a long-term investor? The main lesson is that while market cycles include periods of significant drops and dramatic growth, the overall trend has historically been upward. The key to benefiting from these cycles is to stay invested consistently rather than trying to predict when these rises or drops will happen. Stay consistent. Continue investing through both bull and bear markets. Avoid timing the market. Trying to jump in and out can lead to missed opportunities for growth. Focus on the long term. Market cycles are temporary, but long-term growth has been steady. By staying invested, using strategies like dollar-cost averaging, and understanding that both gains and losses are part of a natural market cycle, you'll be better equipped to navigate these ups and downs without panic. Dollar-cost averaging is ideal for long-term investors because it allows you to build your investment steadily. This approach means you're consistently buying shares at regular intervals, no matter where the market is. Instead of waiting for the right time to invest, you're simply staying consistent and benefiting from the market's long-term upward trend. Over time, dollar-cost averaging helps reduce the impact of market volatility and eliminates the pressure of trying to time the market. Another tip to accelerate your investment growth is to reinvest any dividends. Many index funds and ETFs pay out dividends, which are a share of the profits from the companies within the fund. By reinvesting these dividends, you're essentially using that cash to buy more shares, which helps your investment compound over time. It can boost your portfolio growth. Another tip is to increase your monthly investment amount when your income increases. For example, if you start with $100 per month in your 20s, and next year if your salary increases, you increase your monthly investment to $110 or more. This strategy also aligns with typical income growth, making it affordable as your career progresses. For young investors, gradually raising contributions when possible can boost long-term gains. In our previous video, we showed this long-term investment with gradual increase in monthly amount model can potentially turn into more than $1 million in your 50s to allow early retirement. To recap, by investing $100 a month starting in your 20s, you're setting yourself up for a solid financial future. Choosing low-cost, diversified investments like index funds or ETFs, using dollar-cost averaging, reinvesting dividends, and maintaining a long-term perspective are all key steps to growing wealth over time. Understanding market cycles and focusing on your long-term goals will keep you on track, even during market fluctuations. Remember, investing is a marathon, not a sprint. Thanks for watching. Don't forget to subscribe for more insights and strategies on growing your wealth. Drop us a comment below if you have questions, or let us know what other topics you'd like us to cover. Until next time, keep investing in your future.